What will be a large effect on the market is A, those negotiations going ahead, and secondly, if sterling continues to fall. Rob Dobson, IHS Markit. News released today shows that Theresa May can't start Brexit without the vote of MPs. Now this is set to delay the activation of Article 50. So Rob, what movements can we expect from the sterling on the back of this news?
I think initially the markets will probably view this as a positive development in the sense that they'll interpret it as reducing the possibility of what's known as a hard Brexit. However, the government's also announced that it will be contesting that decision, and the uncertainty that results from then trying to ascertain who, how and when we can actually activate this article will weigh on sterling in the near-term future. And obviously that will have a corresponding impact on economic factors such as inflation.
Now, Rob, we already know UK inflation is on the rise. The Bank of England released their forecast for their quarterly inflation report today. So how should investors view these increasing inflation forecasts?
Well, they increased their one-year-out forecast to 2.7%. Now, that's well above what we're currently seeing for inflation at the moment, so that would be a sharp increase. It's above their central target of about 2%, but it's still within those 1% plus or minus limits they have for triggering a letter to the Chancellor to explain why inflation is so far away from target. However, given that that would be a sharp upward movement, I think investors should be interpreting this really as reducing the possibility of a future interest rate cut, particularly if the UK economy continues to perform better than expected, as signalled by today's PMI data, but also by the bank raising its growth forecast for 2016 and 2017. So ultimately, they should just interpret it as a reduced chance of a further cut, and that may well stabilise sterling a little bit and also could result in a slight knock to equities, which have been rising on the back of expectations of a further cut.
The Bank of England cut interest rates in August, and as voted by the Bank of England today, they remain at 0.25%. So on the back of inflation pressures, what BOE movements can we expect going forward?
The bank said in their release today that they expect it to be equally likely that the next move in interest rates they initiate will be either up or down. So they haven't got this. Before they were saying there was definitely going to be next move was down. Now they've softened that to possibly an increase. Now with the inflationary pressures rising, that suggests that the bank would normally act to increase interest rates to fight those inflationary pressures. However, the cut they made in August, that was largely due to the post-referendum environment. The bank was signalling to the markets that they were willing and ready to act if the economic and financial circumstances dictated that they needed to. And on that basis, they're unlikely to raise rates in the near term just because they won't want to override that and cause the economy to fall back into a contraction. But on the other hand, a further cut, very unlikely as well, because of those inflationary pressures rising. So chances are the bank will take this as an opportunity to wait and see whether or not those negotiations develop favourably and how the markets respond to those and act accordingly as the circumstances arise.
And finally, we've seen a basket of announcements that have shook up the markets today. So what should investors look for next?
I think a lot of the movements in markets are going to be really driven by how this the court judgment on who can trigger this Article 50 for Brexit and whether or not Parliament will be involved. Again, if it seems that Parliament are needing to be involved and there will be a debate in Parliament and there'll also be a vote to trigger that, then obviously that may well reduce the chances of a hard Brexit. And the markets have been very concerned about hard Brexit because of its associated withdrawal from the single market and also from the customs union. So what will be a largely affecting the markets going ahead will be, A, those negotiations, and secondly, if sterling continues to fall, then we see inflationary pressures continue to rise, and that could have a knock-on effect on economic growth and also other price pressures in the economy.
Well, Rob, thank you for your thoughts. That's all from me, but we'll be back tomorrow with our weekly wrap-up summarising this week's market moves.